It's like when banks think that W-2 employees are more safe than self-employed borrowers,
Hmm.
when in reality, like W-2, you can be fired tomorrow.
Yeah,
Self-employed, you're working your butt off to really make things happen to pay for your bills.
you're betting on
So
yourself.
exactly.
Yeah.
So I mean, I think self-employed's obviously safer, but it's the same idea. W-2 is the safer route, like,
Yeah.
but security's not there.
All right, guys, welcome to another episode of The Report. Today, I got two of my favorite lenders on in the industry. They just funded a $3 million loan for my luxury Airbnb out in Scottsdale. They can get you loans done with no debt to income ratio, no tax returns. These guys are big players in this space. I got none other than Jonathan Yoo and Dustin Rosenberg. What's up, boys?
How you
What's
doing?
going on?
Doing good, doing good. Excited for this conversation today. So there's a lot of talk with interest rates and where we are with the economy and that sort of thing. I have heard some news recently that rates are starting to trend downward, and we're starting to see a tick up in loan applications. What are you guys seeing on your front?
I mean, they are for sure. Rates are lower than they've been in the last 4 months, but there's a little bit of a disparity between like what we're talking about, the investor space, non-QM space versus the conventional space. Conventional rates are slightly lower, but non-QM it's a little delayed still, and it hasn't dropped as much as conventional has. But if you're in the space to buy a conventional home or invest conventionally, then it's the time, right? And so
Sure.
applications have ticked up because of that, but I think we'll see what happens in the coming months.
Sure. And
Yeah.
so for the listeners out there that are not familiar, can you break down what is the difference between a QM and a non-QM product?
Yeah. So QM product is what everyone knows and loves typically. 30-year fixed, conventional, FHA, VA. Non-QM stands for non-qualified mortgage. And essentially non-QM loans are your DSCR loans, bank statement loans, stated income loans, kind of the out-of-the-box type creative financing that you would do as a self-employed person or just an avid investor.
Yeah,
Yeah.
absolutely. I think a lot of people out there, and myself included, early on, they don't realize, hey, you can get loans done without a full underwriting of your debt to income ratio and pulling tax returns and all the other stuff that these conforming lenders go through. Talk a little bit about how the non-QM product kind of came to fruition. How long has that been around for?
So it kind of really hit the scene almost 2-3 years ago. Even mortgage lenders or brokers ourselves didn't really know the full way that we were going to release it to the public per se,
Hmm.
right? But the main thing that non-QM does differently than conventional is they look at the ability to repay. We use that all the time, right? Like, is the loan that the client is trying to get, can he or the property reasonably make the payment, right?
Hmm.
Because on a conventional loan, they're so cookie cutter and they're looking at 2 years of tax returns, 2 years of W-2s, pay stubs. Most self-employed clients that have tax returns are smart and they like to write everything off. So they're going to show nothing on their tax returns. But
Right.
for example, a self-employed client, if they've got bank statements, if they own their own business, we'll look at the deposits. How much money does he actually have coming in? And we'll use that, instead of tax returns. And it's just the non-QM space really helps a lot of the people, or mainly the people that don't fit in the conventional cookie cutter box that, we've only seen for 60, 70 years as the only lending option.
Yeah, I love that because a lot of entrepreneurs out there, like you alluded to, myself included, if you're investing in a lot of real estate, you got a lot of depreciation. So on paper, it shows that you're not making much money. From a tax perspective, it's great. But in terms of sizing up personal loans or looking to finance, more traditional conforming loan products, it can be a little bit more challenging. So for me, it's a nice option that we can use to your disposal. You guys just funded my Scottsdale deal as a $3 million cash out refinance, and you guys never took a look at my tax returns or bank statements or personal debt to income, which is quite nice. And from a paperwork standpoint and efficiency standpoint, it actually is kind of convenient as well.
And we close in an entity on that one too.
Yeah.
So that's a big thing for a lot
Yeah.
of clients and investors in general, right? They want to close in entities because they want to keep their name off the chain of title a
Mhm.
lot of times to just for the corporate veil. So
Yeah.
that also assists as well. We can close in entities with these non-QM loans instead of having to close in personal name every time.
Yeah, and that's another good thing. I'm glad you brought that up. So we took title under the LLC name, which is quite nice. So my personal credit score that $3 million loan doesn't even show up on my personal credit report, which is kind of cool, even though I am personally guaranteeing the loan. So, a lot of people right now, I always advise if you can take title under an LLC, but a lot of the conforming products don't allow you to take title under an LLC, and people use their personal name. But I think a lot of people, once there's like a cooling off period, 6 to 12 months, will actually transfer the title out of their personal name and into an LLC. And I know in a lot of these loan documents that you sign at the closing table, it could say that the lender could technically call the note due if you transfer title out of your personal name. Have you guys ever seen that happen before? Because I've never heard of it happening.
Yeah, I mean, here's the reality of it is the documents state that for a reason because Fannie Mae and Freddie Mac, FHA, Ginnie Mae, they all hate entities
Sure.
because of 2008.
Sure.
Right, people were writing names, loans in their dog's name and in an entity, and then abandoning the house. You
Yeah.
know, so they hate it. So I don't think it's people have been doing that for long enough on the mass scale. Like it's been more popular now.
Yeah.
For us to see. But I mean, they can go back and audit whatever loan they want.
Mhm.
And if Fannie or Freddie find out, hey, chain of title looks like you transferred into an entity. It's not supposed to be in an entity. It's
Yeah.
personal. They have the chance to call your loan. It's a real thing, right?
Sure.
People don't realize it. But that's also why non-QM might be a little bit higher in rate or whatever. But for a lot of people, it's worth it because they don't have to put it in their personal name, protects them a little bit. And for the future, even if there's a 1% chance that you can be called, right? That sucks.
Yeah.
So, it protects you from that 1% chance, even if it is small. We haven't seen it, but you never
Right.
know, right?
Yeah.
Yeah.
I've always wondered, like, if you're the lender and your client or the borrower is, paying you the debt service payment on time every month, they're
Yeah.
paying you cash flow. Like, why you want to get them in trouble, right?
Yeah.
So I don't know. But that's an interesting point. So why don't we go back a little bit? How did you guys get into the lending industry? Like, how did that even come to fruition?
Yeah, so we used to work together at a previous mortgage company in San Diego for about 6-7 years together, right?
Yep.
And then eventually, long story short, we just saw that there was a need, like right what we were just talking about, for the investor market because of how difficult it is to get a loan closed going conventional,
Mhm.
and the luxury market. Because most conventional lenders, FHA, VA, they don't cater to helping an investor, buy any properties, refinance any properties, and it goes in line with what Fannie Mae is doing right now. They're making it, not only more difficult, but adding what's called loan level pricing adjustments,
Mm.
where they make it so much more expensive to deter, investors buying properties, right? But we started Convoy Home Loans beginning of 2021, and ever since then we've been pretty much married, you could say, but it's been a blast.
Yeah. And you guys were working together at your previous brokerage before you guys started your own brokerage?
Correct.
Yeah. Is there a lot of hoops and like challenges to go through? Is there like a high barrier to entry to start your own mortgage brokerage?
I wouldn't say it's a high barrier to entry because to be a loan officer, you don't even need to go to college,
Mm.
right? But it does take a good chunk of liquidity, as you know, starting a business,
Yeah.
right?
Yeah.
If you don't have the capital to start a business, then it's very hard to make it and scale it, right?
Yeah.
Because you want to grow, you want to scale it at the beginning, at least a little bit to get you like an operations team to be able to handle your back end, assistants and all that to kind of make it so your focus is being able to sell loans and
Yeah.
originate loans. So because of that, the barrier to entry, I would say, is capital if you want to build it, well. But if you're just going to be a one-man shop, it's very cheap to
Yeah.
be able to do. So you just need a broker's license.
Yeah, absolutely. So how I found out about you guys, I actually got cookied on Instagram. I don't know if I've ever told you guys this
Yeah.
story. I was just going through my feed one day and all of a sudden I see this like this post pop up
Yeah.
and it's from your guys' brokerage and it's like, hey, we just funded this like $6 million luxury Los Angeles short-term rental, 40-year fixed 10-year IO. I was like, at the time, I was in the middle of my Scottsdale project. I was in the middle of the renovation, and I was like, well, I'm going to be having to refinance this
Yeah.
deal so at some point when we get done. And at the time, I didn't know of any lenders that were, financing luxury short-term rentals at that dollar amount. So that's kind of how we connected. And I remember Jonathan and I, we jumped on a call, and we just kind of hit it off ever since. So
Yeah. We spoke a lot. We
We
talked a
did.
lot,
We
right?
did.
It was over a series of months. We talked
Yeah.
a lot. Just trying to get it like solidified in. And I know there was a little bit like, and for the listeners too, like there's always going to be a little bit of apprehension when you first start a relationship because
Hmm.
you don't know if you can trust them or not.
Of course.
But I'm lucky and happy that we built such a great relationship over that period where now we can talk freely and
Hmm.
ask normal questions. And you know what I'm saying, I know what you're saying. It's kind of like an understanding between two people. So
Yeah, no,
yeah.
absolutely. So let's go back just a little bit. So earlier this year, obviously, rates were very, very competitive until early 2022. And then all of a sudden, we see the inflation numbers running a little bit high. The Federal Reserve's like, hey, we're going to start hiking rates. No one really believed that they were really going to do it. And then they started doing like 50 basis
Mhm.
points, and then it was 75, and then it was another 75. And fast forward today, rates are very high now. Um, what are you guys forecasting for 2023 in terms of rates? Are we going to see some sort of reversal? Are they going to hold steady? What are you guys seeing on your front? Learning to become a successful real estate investor can take a lot of time and dedication, which some people just don't have. If you're one of these individuals, this doesn't mean you can't invest in real estate. My company, Summers Capital, is buying a bunch of boutique hotels right now, and you can invest with us in these deals without having to do any of the work. Our team sources the deals, we secure the lending, we take care of all the renovations, and we even handle all the day-to-day operations with our in-house management company, making it truly hands-off and passive for our investors. If you want to learn more to see if we can help you, go to summerscapital.com/invest to book a call with our team. Again, that's summerscapital.com/invest. Now back to the show.
Yeah, I mean, I think what the number is in February is the next federal rate hike, right? I think it's a 94% is what they're penciling in.
Hmm.
They're going to raise it a quarter point, and they're going to raise it again a quarter point in March. Now, usually when the feds raise rates,
Hmm.
the federal fund rate, mortgage rates typically will go up. But in this case, this market right now, a lot of the mortgage rates are going to be tied to inflation, and if the feds actually surprise us on how much they plan to raise the federal fund rate. So if they come out, and raise it a quarter point in February, we're really not going to see mortgage rates move at all. But if they come out and raise it 0.3 or 0.5, get ready for a nice little boom in or uptick in mortgage rates. Now, personally, and I think me and John are aligned, I think we'll see rates slowly tick up, right? Through probably the end of 2023, maybe early 2024. And then we might see a pause, for 6 months or a year, and then we'll see it come back down. That's all, a
Speculation.
speculation.
Right.
But like we get this question asked all the time. What do you think, rates are going to do the
Sure.
next year or two? I'm telling my clients right now, look, if it's going to continue to increase for the next 6, 12 months, for it to get to the point where it is now or be lower than where rates are now, probably looking 2 or 3 years. And that's, hopeful. We'll
Yeah.
see what happens, but that's a realistic kind of best educated guess that I think both of us can make.
Do you think for someone purchasing a property right now, do you think knowing that the rates will be lower 2 years from now or 3 years from now than they are today, are you advising people to get into an adjustable rate mortgage, an ARM versus a fixed?
It's all got to make sense. I think adjustable rate mortgages definitely scare some people because they
Yeah,
just don't want to hear that number or
sure.
that word better said because of what happened in '08, right? But it makes a lot of sense for, in terms of people that know that, let's say they're doing a rehab or they know that they're going to be getting out in 3 years or
Hmm.
what have you. And what we're doing a lot of, this will kind of go back to the product you guys did, the DSCR product, which we can go on in a little bit.
Hmm.
Those normally have prepayment penalties. So what we're doing right now is we're writing a lot of them with 1 or 2 year prepays. So you're not going to be handcuffed to most products a year ago had 5 year prepays.
Sure, sure. Yeah, that makes sense. And so for the listeners out there, prepayment penalty, a lot of these DSCR loans will have a prepayment penalty. So whenever you go to, exit the loan, whether it's a sale or a refinance, the lender wants to make sure that they're getting, a cut of their interest. And so you'll see different prepayment options. The most common is a step down, right?
Mhm.
5, 4, 3, 2, 1, and then you also see some yield maintenance.
Yeah.
Can you guys touch on the yield maintenance? What exactly is that?
So, I mean, there's always a spread when people are gonna be selling the loan, right? Or not selling the loan, selling the house or
Hmm.
doing something, refining out. Um, the 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 banks and the lenders have to maintain a certain level and a percentage within their account, right? And when they sell, their fund and everything. So when they go to fund the loan, they go to sell the loan. They have to maintain a spread, right? Because a lot of these banks they have to work with investors as well, right, on the back end.
Hmm.
So A lot of that might fall under and fall on the onus of the client selling whatever they're selling,
Mhm.
and paying that prepayment penalty, and that helps kind of mitigate a little bit of that yield
Yeah.
spread difference between selling the loan on the bank side, or the selling the home on the buyer side or
Yeah.
the seller side, right? So I think that it's going to come into more play in the coming months, maybe coming year, two
Mhm.
years, because a lot of people, um, the market's changing, right? So a lot of people that, like we were talking about, right now, people are buying, right? They're buying at a higher rate. They're gonna buy later, or they're gonna refi later.
Mhm.
And like Dustin was saying, we're writing a lot with like 1 year, 2 year prepaid, 3 year prepaid. But what happens if all of a sudden everything we said is wrong? And now they're going to be selling or refinancing in a year or
Right.
6 months, right? And at that point, then people are going to start getting a hit, because the banks and everyone, they have to maintain that spread.
Yeah.
So a lot of that onus is going to fall towards the clients. But at the same time, if they're going to refi long-term fixed debt, then it's not really a big deal, but it does come into play there.
Yeah.
Yeah.
I know a lot of deals on the multifamily side with
Mhm.
the big yield maintenance prepayment penalties. We're killing a lot of deals a few years back, but now assumable mortgages. These notes that are assumable to the next buyer are actually very appealing across a bunch of different asset classes right now. So, are you guys seeing a lot of loans being assumed right now on your end?
So I mean, I think the popular term right now is subject to, right?
Yeah.
Purchasing.
Yeah.
And a lot of our circle of investor clients and, influencer people that we deal with a lot, are kind of pushing subject to, right?
Hmm.
I think a big player of subject to is like Pace Morby, right? He
Hmm.
does a lot of that. Um, it sounds great right now, because obviously if you assume a lower rate mortgage, then you don't have to refi out of it. But the idea is you don't refi out of it.
Right.
If you do have to refi out, because a lot of people in 2-3 years will want cash from their
Yeah.
properties, from the equity that they've built. Subject to will become a little bit of an issue on the residential side, at least
Yeah.
on the 1 to 4 units. Um, Commercial side, I mean, usually it's a little different. Prepay, everything's been pretty normal and standard there for years, right? That's been around. But prepayment penalties, these yield spreads, all these things are kind of new to the residential space, 1 to 4. So I think subject to is going to become a little bit of an issue when you refi out, because we've run into that actually
Yeah.
personally, where um, the note is held by someone else. You have to call the
Hmm.
old person. Hey, can you send me this? Can you send me that? I have to, refi out and cash out money, and it becomes a little bit of a headache. So it is very common right now, but the thing that I'm a little wary about is what happens when people want to cash out later, because then they're going to run into a situation where you're going to have to start making some old phone calls back to the previous seller. Hey, the note's in your name. They need you to sign this. They need you to sign that. And then at that point in time, are they really going to be willing to do that for you, right?
Mm.
As a previous seller. So that's something that a lot of people don't think about, because they think, oh, I'm never going to refi. I'm just going to
Yeah.
keep the same rate. But the reality is, I mean, average American refis every 3 to 5 years, right? For
Yeah.
one reason or another.
Yeah.
And if you need to, because you have so much equity now in that house, that's when it becomes, I think, a little bit of an issue. And we'll see that in the coming years.
Yeah.
Yeah.
And shout out to Pace Morby. I know Alex,
Yeah.
and Alex is in conversations with him, trying to get him to come out and visit and get on the show. But real quick for the listeners, what is subject to? What does it mean?
Subject to is purchasing, kind of like assuming the loan,
Yeah.
right? You're not actually assuming the loan, because the note, most times, unless it's a VA loan, typically stays in the name of the previous owner.
Mm.
And you just take over the payments, let the bank know, hey, payments are going to come from this account now instead of this account. And you're buying the property with a lower rate at usually it's like a loan that was written 2 or 3 years ago, where the rates are 2.75, 3, 4, right? So you get to buy the property at a lower rate, had a long-term debt, versus having to buy it right now at like, 30-year fixed at like 5.5 or 5.6, right?
Yeah.
So it allows them to purchase things with a lower rate, while also the seller getting their portion and not having to worry about their payments as well, because it's being taken over.
So
Yeah.
as a seller, though, like if I'm selling a property,
hmm
that loan is still going to stay under my name.
Yeah.
And what's the motive for the seller there?
I think just getting the cash now,
Okay.
right? Because a lot of times, they get a good chunk of cash
Yeah.
up front, right? And sometimes they're willing to carry the note, right? There's like multiple ways of subject to, but the most common I've seen is they either carry a note, or if the new buyer is taking it over, then they get the cash up front. So the sellers, hey, I get to get rid of the asset that
Mhm.
they want to get rid of. I get the cash now. I get to deploy it somewhere else. Um, I see it happen a lot more, not in California much,
Yeah.
more like Midwestern smaller loans.
Why
Because
is that?
I think it's just the loan size, right? If you're talking about something like in California, San Diego, even, or LA, there's not a lot of people that are going to be willing to carry or subject to hand you over like a $1.5 million note or $2
Mm,
million note,
right.
right?
But a $200,000 note,
It's
it's like, okay, you can't
yeah,
really fuck that up.
exactly,
Okay.
exactly.
And then what happens if the borrower or the buyer defaults on the mortgage, let's say a year or 2 years later? Is the seller at risk?
So see, it's a little complex
Yeah.
because it depends on how I think the mortgage was written, the note was written when they actually transferred it over. If they did a full transfer
Mhm.
correctly, which a lot of times they don't do because they don't, like, a lot of people that are doing this are finding out from social media, and they're like, oh, we can make this happen without going through all the legalities of everything, and that makes it difficult. If you do it the correct way, it shouldn't.
Yeah.
But if you don't, then yes, right? The seller is probably going to get burned, buyer's going to get burned. It's going to be a whole fiasco. That's what I'm saying. When we do like refis of
Mhm.
people, like I've had clients have to call their old seller and be like, hey, the mortgage is in your name. I need you to sign this paper, release this paper, right? Because there has to be releases signed
Sure.
for the money to be released into the other person's name. So it may be an issue in
Yeah.
that case. Yeah.
Crazy.
Yeah.
So I wanted to ask you guys, whatever happened with Sprout Mortgage? So I believe it was 6 months ago or so.
Yeah.
Sprout Mortgage had a pretty big team, 500 plus employees, and all of a sudden one day they just said, "Hey, we're closing doors. You guys are all out of work," and they had a bunch of loans on their books. What happened there?
Yeah, I mean, so in the non-QM market, they were one of the biggest players in the non-QM market. Beginning of the year, had, let's say, rates in the low threes, and
Hmm.
basically they kind of skyrocketed, right? Over a 6 month period, basically went from 3 to 6 or 7%, right? So what Sprout had the problem was that they had commitments from Wall Street, who they would sell their loans to, and they had commitments to basically buy, let's just say, a pool or 1,000 loans from Sprout at 3.7. Well, now all of a sudden they've got all these rates that are at 4 or 5, and they can't sell them,
Hmm.
right? So they were stuck with, I don't know what the exact number was, but I don't think we'll ever know, but a lot of money, maybe close to $1 billion worth of loans that they couldn't sell.
Wow.
So the way that the mortgage lenders are able to operate is they're recycling loans, selling them, get new funds. They can keep writing new loans, and eventually they didn't have any funds to lend out, so they had to close shop.
Wow. That's crazy. And then, so who ends up taking all those notes? Because it's got to go somewhere, right? And they don't take them back from the
Yeah.
borrowers, correct?
No, well, the difficult part, and we were part of it. We had a lot of loans actually at Sprout. Was all the loans that they were working on. Like I had a couple purchases,
Uh huh.
dead. Just sorry, can't do anything.
Sure.
Right. But the loans that,
Had closed.
yeah, they basically had to take a haircut. I know they filed, didn't they file
No, I think
not
someone.
bankruptcy, but to get
Oh yeah.
basically all of their, all the loans on their books sold at a discount so they could actually get some sort of, money back rather than losing it all. But still,
Yeah.
they were,
I mean, they didn't pay any of their employees. Like, we had a lot
yeah.
of people that worked there. They were just laid off, didn't pay anybody. I think what they did probably was just use the wages that they were going to use to pay people to do that. And it's called scratch and dent on when we're talking about it from a lending perspective.
Scratching the debt.
Scratch and dent.
Scratch and
Yeah.
debt. So when I hear that term in the future, that's not a good thing.
It's not a good thing.
Okay.
Yeah, it means that it's being sold at a loss.
Okay.
Essentially, and there's like buyers on the street, Wall Street, that buy notes and loans packages, pennies on the dollar.
Okay.
So, that's what they did. They had to sell things at a way loss and fill in the gap between yield spread. They had to fill in the spread
Hmm.
between everything with the funds that were supposed to go to employees. And I mean, I don't think anyone we worked with at Sprout ever got paid still.
Wow.
Yeah.
Yeah, there's a
So
lot of
it's
lawsuits
crazy.
right now between the
Yeah.
employees and
I can imagine.
yeah.
Yeah.
So for the guys who were involved with Sprout, not on the employee side, but the founders and the people that were running that company, they're never going to be in the loan industry again. Is that right? Or
They're
how do you recover from that? Hey guys, real quick, I hope that you're finding value in this show. If you could do me a huge favor and drop a 5-star review on Apple Podcasts or whichever platform you're listening on, it would mean the world to me. Also, if you know of anyone that would potentially benefit from this podcast, feel free to share it with them so we can help more people build wealth through real estate investing. Now back to the show.
I hear that this isn't the first time the previous owner of Sprout has done something like this.
Mm.
I hear, but this is something that we're never gonna understand ourselves as normal people,
Yeah.
because we're probably not gonna be in the space where we're racking billions and being able to pull crowdfund billions together to do something like that. So, but I hear he's gotten out once, he's probably gonna get it again.
Yeah.
I have a feeling it's gonna come back because people have a short-term memory for bad news. That's the
Yeah.
consumer mindset.
Yeah,
Yeah.
absolutely. I wanted to touch on like a lot of these loan products that are maybe more traditional through banks and credit unions. I know some credit unions actually keep their loans in-house, and then a lot of banks might sell their loans off. How does that work? Like, how do these banks and credit unions determine if they're going to keep it in-house or they're going to sell it in the secondary market?
It's basically the model that company, whoever they may be, the credit union, the mortgage lender, want to decide how they're going to operate business. Now, when you're banking and keeping your own loan in-house, well, you're collecting the interest every month, and that's how you can obviously generate some income. Whereas if you're selling a loan, you're not collecting any interest, but you're getting a little premium every time you sell it. So it's there's a different in terms of legal compliance, all of that you have to go through if you want to be a servicer versus just being somebody that's going to be, let's say, selling all of your loans rather than keeping all the loans.
Yeah. Okay. And so who are typically these buyers? I mean, you got Wall Street buyers, right? You got private buyers, like pools of just private investors. Talk a little bit about the different options you have in the secondary market when you go to sell these products.
Yeah, so you've got obviously the Wall Street that we've touched on, those buyers. You've got pension funds, you've got life insurance groups, you've got family offices, and then you've got, obviously on the conventional side, you've got the government. You got Fannie Mae, you got Freddie Mac, you got the VA, you got all those. So depending on the loan product, obviously like a non-QM loan, you can't sell that to Fannie. They're never going to touch
Right.
that. And that's why Wall Street obviously is a very important player in the non-QM space, because they like the fact that they can invest in something that actually has collateral to it. Most of the time Wall Street's investing in something that may not go, right or wrong, but if it goes wrong, they don't have anything to recoup from.
Yeah, I've always thought that. It's like, when you're investing in a stock or crypto, it's like, what are you buying? You're
Yeah.
buying like a ticker symbol on a
Yeah.
computer screen, and you have no control if it's going to go up or down. But with real estate, it's like, I can look it, I can touch it, I can feel it. It's a real thing. People live there. And these properties are going to be around a lot longer than you and I are going to be. And so that's why I've always loved real estate. And so that makes sense from the Wall Street perspective. This is their opportunity to invest in something that is collateralized and backed by a tangible asset.
I think JP Morgan, right? Was it JP Morgan? Read that recently, or was it Chase? It's JP Morgan Chase. Yeah. They just bought into like huge batch of DSCR loans that they're
Really?
buying from. Yeah.
Yeah.
Yeah. It used to be like Goldman and like those guys, kind of a little more aggressive, but now JP Morgan Chase is stepping into the space of buying these like investor loans.
Why is
and
that?
packages. I think it's just becoming more institutionalized across the board. There's a little track record now. I mean, these have only been around for like a year and a half, 2 years, but now there's a little bit of track record. Okay, they don't really default on the loans. The loans perform. Knock on wood, we haven't ever had any loans go into NODs or anything like
These
that.
are the non-QM loans?
Non-QM loans, yeah.
Really?
So JP Morgan Chase actually recently just they came out and there was
It was
a big
pretty
report.
big chunk.
Yeah,
it was a
like
big deal too.
It was like 300 something million or
Yeah.
something like that. They bought a big chunk.
Yeah.
And I think that's kind of like going out into the world like, hey, these things they're not like bad loans, because a lot of people associate non-QM with sometimes bad because subprime, right? It's technically subprime if it's not prime. So I think it's kind of taking away that connotation a little bit and kind of bringing like to, hey, these loans perform and they do well. So hopefully more people get in so these products are around longer, because I like to remind clients too, 2 years ago, these things didn't exist. They were only for commercial loans. And now all of a sudden we have it on residential, but how long is that really going to last?
Yeah.
Right. So we'll see, but hopefully it stays because Dustin and I, we love these things. I mean, you love these things, right?
I
So
do. I
yeah,
don't ever want to do a conforming mortgage again where
yeah,
they're pulling tax returns, going through bank statements,
exactly.
every little thing. It's such a pain in the ass. And so to do these non-QM loans on the buy side or whether I'm refinancing a property, it's so much more convenient
Yeah,
and easier for the borrower. Yeah. And it makes sense, for JP Morgan, for them to invest and buy these non-QM loans. I mean, they're going to get a premium
hmm,
and it's a little bit higher cash flow from their regard and a little bit higher return. So it kind of makes sense. And, if I was betting on or buying loans, I would almost rather take on a loan from an experienced investor that is actually backed by a property or an asset that's bringing in income versus a single family house that maybe someone's living in and they're relying on their day job to support the mortgage.
yeah. It,
Exactly. You hit it right on the head.
yeah, it's like when banks think that W-2 employees are more safe than self-employed borrowers,
Hmm.
when in reality, like W-2, you can be fired tomorrow.
Yeah.
Self-employed, you're working your butt off to really make things happen to pay for your bills.
You're betting on
So
yourself.
exactly.
Yeah.
So I mean, I think self-employed's obviously safer, but it's the same idea. W-2 is the safer route, like,
Yeah.
but security's not there. Yeah.
So can anyone go out and get a DSCR loan? Like, let's say you're a brand new real estate investor, you're going to buy your first investment property. Can that person qualify for a non-QM DSCR loan product?
Yeah. The only difference is that you're going to get maybe a little bit higher rate,
Okay.
and maybe you're going to have to put a little bit more down.
Okay.
Right. So the experienced client or borrower is always going to get the best deal, but it doesn't mean that just because you're buying your first property that you can't get one. And a lot of times, most of the people that we run into on a first time conversation are first time investors, and they don't even know what a DSCR loan is, right? They don't know that, hey, I'm only making 50K on my W-2, but I want to buy this $2 million rental property because I've
Hmm.
got 500K from wherever it may be. Can I
Hmm.
do that? And they're shocked to hear that, look, we're going to look at the asset more than you. As long as you have the down payment, as long as the property is actually something that can cash flow, we can get you the property. And that's why DSCR has been so popular.
Yeah. And just to break down the DSCR for any listeners out there. So DSCR is a debt service coverage ratio. And so you guys will underwrite is it the PITI is what you'll factor for the expenses or just the P&I?
It'll be PITI, or if it's interest only, ITI.
Okay,
Yeah.
got it. So principal, interest, taxes, insurance, whatever that's going to cost annually. And then they'll look at the income that the property is going to bring in annually. And they typically want to see anywhere from a 1.2, maybe a 1.25 debt service coverage ratio, meaning the income should be at least 120% of whatever the annual PITI should be. But I know you guys have other products that maybe they don't care so much about the DSCR requirement. Can you guys touch a little bit about that?
Yeah, I mean, we have like no DSCR programs because right now in this market we're kind of in a weird space where rents aren't fully caught up in some markets
Sure.
to what it should be.
Or what
So
if you're buying a property that, hey, the rents are, 35% below where they should be,
exactly.
but next year they will be there.
hmm And so for those, I mean, it makes sense to buy it with maybe a no ratio, which
Hmm.
means like we don't look at DSCR at all. Or we have products at like 0.8, 0.5, 50% coverage, 80% coverage. Most of ours just has to be 100% coverage. That's it. But if you want to talk about top tier, I think it's only 110 for us. Top tier programs are 110% coverage. And that's kind of like what we talked about in your office a little bit
Yeah.
of our, we have a fund that's buying our loans right now, 30-year fixed DSCR at like 6.3, 6.5. And even interest only, it's like 6.6, 6.5. So it's that's only 110% coverage. That's not
Wow.
125
Wow.
or 120. So at 110, we can get those types of programs. Obviously, it's more premium borrowers and experienced borrowers with more liquidity, but that fits a lot of people's buckets. And that's like 2.5 points lower than the rest of the market on normal DSCR loans, even
Yeah.
at 125% coverage, right?
Yeah.
So it's really like we are trying to constantly come up with new products to allow our investors to make more money, acquire more real estate, build their portfolio, and so I think that's where it kind of falls. But that's like DSCR 110%, you're good.
Yeah.
Yeah.